Let's connect the macro into the micro with some stock picks with Lukasz Tomicki rejoining us. And with a little top-down start to our discussion, Lukasz, good to see you again, joining us from LRT. And you write that you see there's plenty of room for disappointment this year in the macro. Let's kind of start there as your baseline.
Good morning, Oliver. Yes, indeed. I think the markets are effectively priced for perfection. And to me, when you start looking at the S&P and interest rates and where expectations are for earnings, there's plenty and plenty of downside. So for example, just take the S&P's earnings for the first quarter. We're looking at about $186. Analysts are expecting somewhere around 12 to 13% growth this year, which, by the way, is double the historic average. So then, okay, let's say they're right. Let's say the economy actually grows very fast. Companies grow at double the average, what they've grown historically. So we're at 210, 215 maybe for earnings. Then let's say the interest rate on the 10-year treasury stays around 4%, slap on a 4% equity risk premium, which is where it's been historically. Well, that gives you a justified PE of 12.5. And 12.5 times 210 is what? 262. So that's a 40% downside in the S&P. So, maybe I'm being too hawkish here, but let's say the 10-year falls to 2% and the equity risk premium falls to 3%. So investors get more bullish. Well, in that case, I have a 13% downside in the S&P. So it's really hard to come up with scenarios where there's reasonable upside. The only thing you have to believe is that we're going to get extremely fast interest rate cuts while earnings grow very quickly. And it's very hard to see how those two things happen simultaneously. Now, look, I want to be clear. They could happen, but if you're betting that the market has a strong year this year, you're effectively betting to the market returning to a situation that we had in the late 2000s. The late 90s with the internet bubble, or what we had in 21 with the craze with SPACs and what's happened there. So it could happen, but I don't think that's a reasonable assumption as a baseline expectation.
So the idea that we're in the midst of an AI revolution that'll be the next internet, or a blockchain revolution they've been telling us will be the next internet, it doesn't sound like you're really buying that.
Oh, it may very well be. But historically, when there's transformative technologies, the benefits of that technology are captured primarily by consumers. So the internet was a fantastic thing. I have no doubt that the internet changed our lives. It changed my life. It changed how we're doing business. It's changed every industry in the world. And yet, we had a huge run up in the late 90s, 99, 98, and we had a huge internet bubble. So even though the reality came true in a sense, the stocks took years to recover. I think Microsoft took 13 years to recover even all the losses it had from the peak. Cisco is still below its peak. I mean, so just the fact that a technology comes around and changes things and can really have a transformative impact, I'm not denying that, but that doesn't mean you're going to capture that as an equity investor.
Do you think it's then a short opportunity, or do you go to the stuff that's out of focus that the market hasn't bid up, and what's left in that category?
Yeah, so I think for me, shorting individual names is incredibly risky still because there's really no capped upside. And so while I think NVIDIA is trading at a valuation that's very high and implies some kind of profit nirvana forever, who's to say it doesn't double from here? That's just the reality of what we've seen in the market. And certainly we've seen that with GameStop and with other names. And so being short individual names, especially being short with leverage, can be a career-ending move. And I frankly don't recommend that to anyone viewing at home. For me, it makes a lot more sense to go to names that haven't participated or that for some reason are beat up. And so I'm looking for good quality companies that for whatever reason are going through operational difficulties, which I think are temporary.
Okay. Let's start with one I think people are going to recognize, which is in the retail category, Estee Lauder, Dollar General. Both stocks that kind of seem to fall behind competition in some ways. EL in particular, one of the narratives I've heard is that their international presence has been a little bit more susceptible to economies that have been a little bit more volatile than the U.S. I mean, the stock chart is just awful. Lukasz, you're in the, I mean, is this the discount bin or is this the can't keep up bin?
No, to me, this is definitely the discount bin. And, the chart looks bad in a 1 year look back. But in fact, even if you look back 5, 6 years, it looks terrible. That means the investors have effectively lost money in this name for about 5, 6 years. And the reason is the stock was priced to perfection. It was priced based on growth in China and other emerging markets. And that growth was happening, but it was clearly overvalued and the expectations were overhyped. And China has slowed, as you astutely pointed out, and there is more local competition. Now, the earnings have been dramatically cut. The stock has gone nowhere for 5 or 6 years. So I guarantee you there's not a lot of cheerleaders or fast speculative money in the name. In fact, there's probably still plenty of people trying to bet against it. And I think there's reason for that in the short term. But in the longer term, Estee Lauder owns a fantastic collection of brands. It's a globally diversified business, which again, right now is hurting them. But I assure you there will be a point in which other economies will be outperforming the US. Maybe not today, maybe not this year, but the market's always forward looking. And so the earnings expectations are down dramatically. The valuation is down. The stock is really bombed out. And I don't think it's a business that's going away. And on the flip side, remember that we still do live in, call it the Instagram generation, where beauty, cosmetics, looking good matter more and more. And there's more and more people entering the middle class globally, and Estee Lauder should participate in that. And again, you're starting from a place where expectations are very low.
Okay. So the expectations definitely low at this point. Your point about the whole demand for makeup and beauty seems to be very true, right? Just from observational standpoint. It also, though, seems like there is a price point specificity that the market takes with retailers, which is you want to be discount, you want to be popular and high quality, but you don't want to be super expensive unless you are like a Lulu and people are willing to pay a super high premium. So I think there's kind of a transition there into the Dollar General conversation. How do you view these companies as hitting their price point correctly? Do they need to make any changes?
So I think what you astutely pointed out is you want to be either very high end or very low end. So you want to be the Dollar General or you want to be the Williams Sonoma. You don't really want to be JCPenney or any of these kind of stuck in the middle type names. With respect to Dollar General, it's really a duopoly in the United States when you look at discount dollar stores. Dollar General has done fantastically well during the pandemic, and now they're doing slightly less well. And so the comps for them have been terrible. They've had too much inventory. Same-store sales have turned negative, and that's weighed on the stock. But the operational model, I don't think is fundamentally broken in any way. And because of their logistics and supply chain controls, because of their numerous locations, which they're heading to close to 20,000 in the next 5 years, it's a very well-positioned company, especially compared to its competitor, which is Dollar Tree primarily. And that's been a disaster for many years. And if you look at the two stores today, just do a store visit, you'll understand why, based on the merchandising.
Okay. What about the fact that Walmart and Amazon are in your competitive, bubble? It's tough going up against them. I mean, Costco too, to an extent, maybe doesn't have the same customer, but it just seems like you got to have a grocery presence if you're going to be a staple these days, and there still is fairly limited.
No, and I agree. I think it is not clear to me that Dollar General directly competes with Costco or Amazon. And Amazon has been around for quite a few years. It's not a new company on the block. Dollar General really serves primarily urban customers or customers that have limited choice otherwise. that buy small quantities of goods at low total prices. So these are not the same customers that a Costco might have. And there's always been competition from Walmart, and yet Dollar General has continued to grow and take share in the industry. So I don't see direct problems from competition. There's plenty of space for both players to be there. The mega shopping retailers as well as the smaller dollar stores. Again, unless you're looking for fresh, nutritious, high quality produce, you're not going to get that at Dollar General. But I assure you, there's plenty of Americans that are simply not looking for that. They're looking for a small number of items at a low price in a small package. And that's what you're getting at Dollar General.
All right. Hey, Lukasz, your wild card pick here for a sec. We only got about a minute. Give me the 60-second pitch for FNV, a Canadian gold mining royalty play.
Absolutely. So Franco Nevada Corporation is a unique gold miner. We think it's one of the best ways to play gold mining and effectively the ongoing deficits that the U.S. seems to be running. If you believe that we're going to print money forever and you think oil is going to go up, you think gold is going to go up, gold miners seem like a way to do it. Franco Nevada is one of the best ways to do it. They own royalty interests in other mines. They effectively help finance junior miners, and then they benefit by taking a certain part of the production of those mines. So it's a direct play on looser monetary policy in the future, sustained deficits, and dollar devaluation. The stock's gone nowhere for several years. We think it's a due for a bit of a rebound once we see the end of the fiscal the monetary tightening that we're seeing now.
All right. Great stuff, Lukasz. Thanks for the details.
Thanks so much.
Always a fun chat. Lukasz Tomicki, founder, managing partner, LRT Capital Management.